Wow, that's quite a disclosure from IndusInd Bank. An adverse impact of 2.35% on their net worth. That's a pretty big number, right?
Right, it is significant. And, the market definitely reacted. I saw their stock tanked over 25% after this news came out, hitting a new 52-week low, even touching 670 rupees on the NSE.
670 rupees. Seriously? I mean, what exactly happened? The announcement mentions discrepancies in their derivative portfolio. What does that even mean?
Well, it seems during an internal review following some RBI guidelines from September 2023, they found discrepancies in how they were accounting for derivatives, specifically related to their other asset and other liability accounts.
Okay, so it's like they found a mistake in their books. But derivatives, aren't those supposed to, reduce risk, not create problems?
Ideally, yes, but these discrepancies seem to have built up over time. They're estimating this 2.35% hit to their net worth as of December 2024. And actually, they've even brought in an external agency to validate their internal findings.
An external agency? That sounds serious. So what's the time frame here? When will we know the full story?
They're expecting the external review to be completed by the end of the fourth quarter, and they'll consider any resultant impact on their financial statements based on that report.
Got it. So we're looking at potentially another month or two for clarity. But the bank says their profitability and capital adequacy remain healthy.
That's what they claim, yeah. They're saying they can absorb this one-time impact. But the market's reaction tells a different story, doesn't it? It's a classic case of uncertainty spooking investors.
Absolutely. Uncertainty is a killer. So basically, they messed up on how they were accounting for these derivatives, and it's going to cost them. But where did the extra income go? Was it boosting any specific line in their financials?
According to the conference call, the income mostly went to their interest income line. So it seems that will be where they need to make adjustments to correct their historical numbers.
So they were overstating their interest income. That's not a great look. I wonder what the restatement will look like.
Yeah, I imagine that's what analysts were grilling them about on the call. I heard that they plan to disclose full information about the restatements along with their results, or maybe even beforehand.
Good. Transparency is key here. So these derivatives, were they related to hedging or trading activities?
They were used by the balance sheet management desk, specifically the ALM desk, for hedging foreign currency deposits and borrowings. So when they convert those into INR, they use these derivatives.
Okay, so they were trying to manage their currency risk. It's like trying to adapt a recipe when you're missing some key ingredients and you end up with something a little off, right?
Exactly. And it seems like the off part accumulated over a while. Someone asked about the time frame, and apparently these practices have been going on for 5 to 7 years.
Wow, 5 to 7 years? So this wasn't a recent slip up. It sounds like a long-standing process that had issues.
Right, the bank stated that the process was in place for that long, and they realized a discrepancy when they had to adopt a new framework in April 2024.
Speaking of the new framework, do we know more about what changed in April?
The new guidelines stemming from the RBI's directive in September 2023 required them to discontinue internal trades. Previously, they used internal trades for hedging instruments with little liquidity in the external market.
Internal trades. So they were trading derivatives with themselves? It's like playing chess against yourself and declaring yourself the winner, right?
Well, the bank stated that those internal trades were entered only for trades with little liquidity. For example, long-term yen deposits or dollar borrowings from multilateral agencies. But with the new guidelines, they can't do that anymore.
And that's when they noticed the accounting issues.
Yes. Before, the external trade was marked to market, while the internal trade was on swap cost accounting. According to the bank, the two legs would vary but converge on maturity.
So the external trades were based on current market value, but the internal ones were valued based on a cost.
Right. And when they repaid borrowings and unwound the internal trades, they found discrepancies where one trade was hitting the P&L and the other was hitting the asset book.
So it sounds like a difference in valuation methods between the internal and external trades caused the whole mess, right?
Exactly. It's like having two different speedometers in your car, and one is slightly off leading you to miscalculate how much gas you need.
Okay, that makes sense. Did they say anything about who was responsible for all this?
Well, they were a bit cagey on the call when asked about that. They said they were still investigating and would answer that question once they got the final report.
Ah, the classic "we're looking into it" response. Now, one thing that worries me is how confident are they that this is a one-off issue? Could there be other skeletons in the closet?
Good question. One analyst asked whether the scope of the external review could expand. The bank said they started reviewing their derivatives book after the December 22nd circular and are comfortable that they should be able to identify the gap by March end or early April.
Okay, that's somewhat reassuring, but still, you never know. And it seems like investors weren't fully convinced, hence the huge stock drop.
True. And what about the RBI? Were they involved in identifying this issue?
Apparently not. The bank was quick to point out that this was an internal discovery, not something flagged by the regulator.
That's a key point. Finding it themselves is better than being told to find it, right?
Definitely. However, one analyst asked if there are any other impending investigations from the RBI, considering the recent CEO extension.
And what was the response?
The bank said that RBI does thematic reviews all the time: KYC, loan assets, microfinance, credit cards, corporate banking. They said nothing material is happening right now that they're worried about.
All right, so nothing specific, just the usual regulatory oversight. If you are interested in this topic, please feel free to like, share, and subscribe to the YouTube channel. Disclaimer: we advise investors to check with certified experts before taking any investment decisions.
Sounds good. So, what's the overall takeaway here? Is IndusInd Bank in serious trouble, or is this just a manageable blip?
Well, it's certainly a significant issue, but the bank is trying to project confidence. They're saying they have enough reserves and capital to manage the transition.
They did say they would have another call in April to provide more information. Let's see what comes of it.
Exactly. And, remember, the market often overreacts to news like this. It's like hearing a loud noise in the middle of the night. Your imagination can run wild.
True, but sometimes there really is something to worry about, right? So, what should investors do in the meantime?
That's the million-dollar question. I think investors should wait for the external review to be completed and for the bank to provide more clarity on the restatements before making any rash decisions.
Agreed. And, as always, it's important to consult with a financial advisor before making any investment decisions, especially with news like this, right?
Absolutely. Don't panic sell, don't blindly buy, do your homework and make informed decisions. So, final thoughts?
This is a developing story, and it's important to stay tuned for more information. IndusInd Bank has a lot to prove in the coming weeks.
Definitely. And it's a good reminder that even well-established financial institutions can have accounting hiccups.
Indeed. And that, my friend, is all the time we have for today. Thanks for breaking down this complex situation with me.
You're welcome. Always a pleasure.